I've got a really good friend named Chris. He and I work together. He actually lives just down the street from me. We're really good friends. We have a lot in common, and so oftentimes we like to bounce business ideas off each other and, a couple different things. The other day I was at my office and he came by and stopped by and we were chatting for a little bit. And then he casually mentioned that he's putting $300 a month extra onto his mortgage. And I couldn't help but cringe a little bit. Now you might find that funny or strange that I would think that. Most people find that to be great. That's a pretty lofty goal to pay off your mortgage. But let me explain why I think there's a better use for your money. I'm Bryce with SaneSense.com, and today we're talking about 6 reasons why you should never pay off your mortgage. Typically, people will come to me and they'll say, why should I never pay off my mortgage? Everybody knows that when you look at the amortization chart, usually you'll have the principal pay down and the interest paid down separated, and people see that they're paying so much in interest, even more than the principal pay down for the first half of the loan, that they're thinking, wow, I want to pay down the principal as fast as I can. And I've got a different school of thought. My opinion is that your mortgage is the cheapest amount of money you will ever borrow. If you look back to October 1981, interest rates hit 18%, which is insane to think about right now. Interest rates just barely raised to about 5%. But over the past 3 to 5 years, if you've purchased a new house, chances are your interest rates are going to be right around 3%, 3.5, even 4%. Now, if you look at credit cards, if you look at student loans, if you look at auto loans, typically student loans can range from 5 to 8%. Auto loans are generally 4 to 5%. Credit cards can be as high as 25 to 30% interest rate. So when you look at your mortgage and you're thinking 3.5%, that's really not that bad. And so rather than dumping all this extra money on your mortgage, use that to pay down other high interest debts, credit cards, pay off student loans, pay off auto loans, because right now we have historically low interest rates, and it's going to be a while before we see those drop to what they have been over the last couple of years. In 2017, the S&P 500 returned a whopping 19%. So if you look at your 3.5% mortgage versus 19%, why would you be dumping more money here when you could be making higher returns here? 2018 hasn't been so good. We had a good market until about September, and then recently things have really dropped with oil prices and things like that. So it hasn't been as lucrative for most people, but still, over the long haul, the stock market returns generally 8 to 10%. And if you're getting that, you're doing pretty well. That's average if you follow an index fund, and so it's better to dump your extra money into an index fund or the stock market in general instead of paying down your mortgage. One of the things most people have on their side is time, and being able to put that in the stock market and invest it and let it compound over and over and over is one of the benefits that a lot of people don't think about. People still think about inflation and they say, well, inflation's about 3%, but even still, if you're getting 8% returns, that's more than making up for the difference in inflation. The third reason that I think it's dumb to pay off your mortgage early is that the interest that you pay on your mortgage is tax deductible. Now, tax deductions for individuals, not necessarily for businesses, but for individuals are few and far between. And recently, with the changes that they've made to tax law in the last year or two, the number of tax deductions that individuals can take is getting lower and lower and lower. Every month as you pay your mortgage payment, a certain amount goes to principal and a certain amount goes to interest. If you're in the first 15 years of a 30-year loan, the majority of your payment is still going towards interest. All of this interest that you're paying is tax deductible, meaning it lowers your taxable income, meaning it's more likely that you'll get a tax refund from Uncle Sam come refund time. Reason number 4 is that paying off your mortgage places all of your eggs in one basket. There's something to be said about diversification. Now, I personally love real estate. I think real estate is great. But when you pay off your mortgage, you're taking a concentrated gamble on residential real estate. And that's residential real estate in your specific town. That's residential real estate in your specific neighborhood. In your specific neighborhood with specific traffic patterns and specific shrubbery in your front yard. Do you get what I'm saying? Being house rich and investment poor isn't the most ideal situation. There's something to say about liquidity. So should something catastrophic happen in your life, say you lose a job or there's a death in the family, having your money in other investments should be able to keep you afloat temporarily, which is much better than tying everything up in your own mortgage. Reason number 5 is that different investment vehicles have better legal protection than your mortgage. So our society right now is so prone to suing other people. If you have a pulse, chances are at some point you could be sued. Paying down your mortgage ties up all this extra equity in your house. Should somebody want to sue you, what they'll do is they'll go to a lawyer, the lawyer will pull up a list of personal assets, and they'll see, wow, they've got a lot of money tied up in the equity in their house. Is that something we want to pursue? Absolutely. But if you're placing your money in a 401k or an IRA, it's a lot easier to tap into. In most cases, you can't tap into it at all. The only exception to that is if you're going through a divorce, oftentimes your spouse will have legal right to the money in those investments. Reason number 6, your money will be worth less in the future. Whenever you borrow money and pay it back later in the future, it's generally a good deal in the sense that you're paying back creditors with devalued currency. So the $20, the $200, or the $200,000 that you agreed to pay back in the future will not be worth as much as it is today. For example, $1 today is worth significantly more than it will be worth 25 years from now. In fact, given our current inflation rate of about 2.5%, $1 today, 25 years from now, will be worth less than 50 cents. So, if a lender agrees to lend money to you, but tells you that you can pay them back with devalued money in the future, you'd be stupid not to take them up on it. Now, to wrap things up, I guess I shouldn't say that you should never pay off your mortgage. So, of course, it's a good thing to do at some point. If you're watching this video and you're 50 years old or older and you're starting to approach retirement age, chances are now it's a good time to start looking at finally paying off your mortgage. I personally am just more of a fan of capitalizing on the amount of time that I have available left in the market and the different diversification and cash flowing assets that I can build instead of dumping money into my mortgage. At some point, of course, I want to have a paid off house, but until then, I don't think it's worth it. But even having said that, once you pay off your house, you're not 100% free and clear. You're still going to have homeowners insurance that you pay. You're still going to have property taxes that come by each and every year, and those will never stop coming. So your house is never really yours 100% free and clear. That's it for this video, guys. Thanks for watching. Like and subscribe, and we'll see you in the next one.